Hey guys, KYT here, and yes, I am putting out videos at a much accelerated pace, and I hope you guys appreciate that. And in this video, we're going to talk about leverage investing and whether some new ETF products with leverage are better than my dear old XEQT. My last video was very well received. It attracted a lot of new viewers, a lot of new subscribers. So I'm going to reintroduce myself on this channel. My name is Young Tom, KYT for short. I'm 38. I'm a new dad. I have a degree in software engineering. I've grown up competing at the highest levels in different strategy games, whether that be chess, poker, Magic the Gathering, daily fantasy sports. I do not have a degree in finance, but maybe that's why I'm able to explain things through that non-finance lens, being able to dumb it down for us lay people who might not understand every complicated financial term. If not, please let me know in the comments why you enjoy my channel. As always, before I start, I gotta recommend Wealthsimple to all the new investors. There's links in the description to starting an account on Wealthsimple, Questrade, or Interactive Brokers. And if you use one of those links, you get bonus money when you sign in and start your initial deposit, which gives you a great boost to your investing journey. Let's start things off with a simple definition of what leverage is. Leverage is like using borrowed money or financial techniques to amplify your potential gains or losses when investing. It can magnify the impact of your investment, making it more profitable if things go well, but riskier if they don't. And for those who want a real life example, you can imagine having $10,000 invested in XEQT, but then you borrow $10,000, an extra $10,000 from a brokerage like Interactive Brokers, to double your investment and double the amount of your shares that you have in XEQT. So if XEQT goes up 15%, you expect your portfolio or this part of the portfolio to go up 30%. If it goes down 50%, you will be down 30%. Now, the two most common ways to get leverage in Canada is one, using leverage with a brokerage like IBKR, which is the example I just talked about, or two, investing in a leverage ETF. And these leverage ETFs, they just work like any ETF or any stock that you can buy. Very easy. You just put the symbol, the ticker symbol, and you're ready to go. And I've been navigating through Reddit and many different groups to see what people think about leverage in general. And some people think their initial reaction is that it's way too risky, that you're playing with fire. But they're the same people that might think individual stock picking is okay. So I think everyone has a different idea of what's risky to them and what's too risky. And to me, it's a spectrum, and as long as the risk is compensated risk, that means that you expect a higher return for taking that risk, then it's something that needs to be seriously looked at. There's a reason why people think having a higher allocation to stocks long-term is better, because stocks have a higher expected return than bonds despite the higher risk. And I also understand, after talking to a good friend of mine when I was talking about how I was going to get my first car, I was going to lease it, and they thought it was a bad idea because that would mean having debt. Like, I'd have to make monthly payments. And some people's experience or how they, again, view the riskiness of debt is really different from mine. They might think that debt is bad at all costs. You should avoid it. And, so for me, leverage is something I'm doing because after considering a lot of options and looking at the good and bad sides, I think it's worth a serious look. The paper that got me interested in leverage was this one: Life Cycle Investing in Leverage, Buying Stock on Margin Can Reduce Retirement Risk. And the conclusions were, by using leverage, the expected retirement wealth is 90% higher compared to life cycle funds and 19% higher compared to 100% stock investments. The expected gain will allow workers to retire almost 6 years earlier or extend their standard of living during retirement by 27 years. And the original idea, the thesis was, by employing leverage to gain more exposure to stocks when young individuals can achieve better diversification over time. And I read deeper into the paper. Basically, as we know, stocks perform the best, or the risk is reduced when you have a long time horizon. The problem is most of us will only have a lot of exposure in terms of raw money when we're much older, right? The time horizon that we can invest in is like this, but we finally am able to save a decent amount, and so we are highly exposed to stocks later in life. So, but in that time horizon, maybe the best returns are at the beginning of this this timeline. So you want to be increasing your exposure to stocks at the beginning when you don't have much money. And the way to do that is using leverage. So before we dive into my Interactive Brokers account to see how that's doing, how my leverage is doing, let's look at how XEQT has done normally with no leverage. About 14% return, but that's without the yield taken into account. And if we jump in, we see my rate of return year to date is 28% in my IBKR account, which is what we would expect. 14%, double that, 28. Now, I haven't been actively adding funds to this because ultimately this is the account I want to add last. It's an unregistered account. I want to focus on maximizing my RRSP and my TFSA. But 2 years ago, I was able to maximize those accounts up to that point. So I created this, put some money, haven't touched this. I set the leverage to 2. That's very aggressive, but it was also the number, the example used in the article. Now let's talk about one of the main fears of having leverage, which is to get margin called, to have your positions closed for you. And that's, the broker has to do that to protect their loan. Basically, they want to make sure that they get their money back. So let's show a concrete example of that where we have round numbers. I have $10,000. I borrow $10,000 and I invest $20,000, the whole $20,000 into XEQT. And the leverage ratio is 2 to 1 because the ratio is the total invested versus my money, my equity here. So if XEQT drops down to 50%, I would have 10,000 left. And that's the amount that was loaned out to me, 10,000. So at that point, in order for the broker to make sure they don't lose money and to collect that 10,000, they would close that position. They would sell all the XEQT that is needed, make sure they get that 10,000 back, and they take back their loan essentially. So I don't get to, the reason it's bad and people don't like it is you don't want to sell your positions because you hope when there's a dip that you have a chance to rebound. And with this, the position just gets closed out. Now we move on to margin requirement. Essentially, in our previous example, we went down to 0, broker collected their loan, but they don't want to wait for you to go to 0 because what if there's a quick sharp drop? Then they won't be able to sell and close your position in time to collect their 10K back. So they need to be able to margin call you before that, before your equity drops to 0. So for something like XEQT, the margin requirement is 30%, which is, we can calculate it by using the 20,000 to see what 30% is, which is 6,000. And different ETFs or stocks will have different margin requirement based on how risky they are and their historical performance, how stable, how diversified they are. Index funds are going to be roughly 30%. So instead of having it drop 50%, XEQT 50% for it to get its loan back, it's going to do that when the stock drops from 20,000 invested to 16,000. So 20% drop, and I would get margin called here in this particular example. There are adjustments I can make as my investment goes down to 6,000. In this example, I can add more money. What this does is it moves me away from the 30% margin requirement. And I just wouldn't want, especially in XEQT, something that I think has a positive expected return, I wouldn't want that position closed by the brokerage. If we jump back to this paper and actually go into one of the tables in the appendix where it looks at the performance of the S&P and across 79 years from 1928 to 2007, and it looks at how often the investment would have been margin called for different leverage ratios. So if we look at the leverage ratio that I'm doing, which is 200%, out in 79 years, only 5 months would there have been a margin call, and 0 for 25%, and I'm 30%. So I'm somewhere between that, and S&P is US centric, XEQT is more global, so it's going to be slightly less risky, of course. And in this example, it shows that you get margin call if you do absolutely nothing during that month, and that's their methodology for this. And that means that in 79 years, there were 5 months where there were these sharp drops of roughly 20% that closed people out. So that is the risk. So going back to this doc, that covers my experience using method number 1 here, using leverage with a brokerage. Now let's jump into investing in leverage ETFs. Now, what actually piqued my interest to look at leverage and leverage ETFs again was one of the more recent videos from Passive Income Investing. Adriano who came up with a video better than XEQT and VQT, two game-changing ETFs, and talking about HEQL and EQCL. So I had to keep an open mind, take a look. Is it much better than XEQT? And let's dive into that. But shout out to Momentum Finance, who appears right here. This is a cool guy. Subscribe to him as well. I'm actually going to look at leverage ETF as a whole in a more general sense to understand why I probably should avoid these ETFs. So looking at SSO Ultra S&P 500, this one particularly because it's one of the most popular leverage ETFs. And if we go and look at the investment objectives, it says ProShares Ultra S&P 500 seeks daily investment results before fees and expenses that correspond to 2x the daily performance of the S&P 500. Now this daily, the word daily is key because when I watched Ben Felix's video on leverage and the Plain Bagels video on leverage, they talked about this performance decay, this volatility decay of these leverage ETF as to why they are not as great as they look. And it took me a while to understand what that meant. Like, why does this daily reset matter? And let's get into it. Yes, we're back in the spreadsheet lab, and I want to preface this by saying this isn't actually how the leverage ETFs work. They use more complicated financial instruments like derivatives that include futures, options, things like that. That's beyond the scope of this video. And here I just want to make a simple example to show why daily reset can cause this performance volatility decay. So going back to our simple example of having 10K ourselves and borrowing 10K for a 2-to-1 leverage, what if the ETF or whatever we're investing in, again, let's say it's XEQT, goes up 20%. So if it goes up 20%, we now have an equity 14,000. The loan is still the same. And now our leverage ratio, which is once again, we take our equity and it's that ratio between our equity and the total of the equity plus the loan. So 14 to 24, we get 1.71. And at the end of the day, what the ETF has to do is it has to reset that leverage back to 2. So essentially what it's doing, if the price goes up, well, you have a lot more money to play with. So you would borrow an additional 4,000 here to have that leverage back to 2. And now what happens when the stock or ETF drops 20%? So here, 10,000, our equity becomes 6,000 because it goes from 20 to 16. Our leverage ratio is now at 2.67. And for it to reset, we have to sell shares. Shares we bought using the loan because we have to reduce the loan so it matches 1-to-1. And since our equity is now only 6,000, we have to sell $4,000 worth of XEQT or whatever to get back to 6,000 to get back to this leverage ratio. So because of this daily reset, it means any movement, and it's going to be worse if it's very volatile. That's why some people call it a volatility decay. It's because as it goes up, you're going to have to buy once the price is appreciated, and you're selling when the price goes down. And you have to, if that happens a lot, you're basically buying high and selling low constantly. In very volatile markets, there's going to be, the decay is going to be felt a lot more. But if you're lucky, and that's why these vehicles, the leverage ETFs, are known more for short-term investing, like daily investing, because if it moves one direction, you're going to capture the entire gain and you're not really going to be impacted by this. And if for some reason you actually invest in this for a longer period of time, but for the most part, it goes up. Obviously going down one direction doesn't really help you. So it has to like go up and sort of in a not very volatile way. That's when you don't have as much performance decay. Now let's quickly go back to setting leverage manually ourselves using something like Interactive Brokers. The thing about when the 10,000 goes to 6,000 in our scenario, we don't have to sell. We don't have a daily reset. We can reset anytime we want the leverage. We can add more money. So in this case, if my equity goes down to 10,000, maybe I find 4,000 somewhere to bring it to 10,000 again to have that 2-to-1 ratio, and I don't have to sell the part that was invested by the loan in order to make it work to have that leverage. And the leverage could be anything. It could be 2 point something. It could be 1 point something. I can just leave it, let it be, and have the leverage change. It doesn't have to reset. So that's why having it being manual is better as long as you're able to control the leverage yourself and keep an eye on it. The downside is obviously if you're too close to getting margin called, and that's the main downside. Now we jump on the Horizon's website to check out the fancy new ETFs, HEQL, EQCL. There's even GRCC now. It seems like they're trying to make more asset allocation ETFs, which are really popular. Of course, VQT and XEQT are extremely popular, and they're merging it with something else that a lot of people like, which is leverage or covered calls. And let's just jump into HEQL. And this is basically using HEQT, which is their version of XEQT, and applying 125% leverage through cash borrowing. So the management fee is a bit higher, but we would expect that in exchange for that leverage, you're going to have to give up something somewhere, and the management fee is at 0.45%. But it doesn't talk about, I looked at the whole page, so sure, it's just having a huge weight on the Horizon's ETF. And again, I looked everywhere. I didn't see where it would daily reset or anything, but ultimately it doesn't even matter, I think, if it's daily reset or not, as long as it needs to reset its leverage at some point, means that it will be forced at some point as part of its strategy to sell its shares when it goes down. So I think it's not going to be a great, for that reason, it's not going to be a great long-term hold, because ultimately they're at their best when the market is moving one direction. And as a long-term investor that plans to hold something for the next 30 or 60 years, this is not the vehicle to do that with. But of course, those of you who want to be more short-term or do some short-term trading, I guess be my guest. But on this channel, we are probably avoiding this ETF. On EQCL, I'm not going to have to talk too much. Ben has done extensive content on covered calls and how they're suboptimal as long-term holds, and how, and in this video, we talked about how leverage ETFs aren't that good. So you're combining two things that aren't that good. Probably not for any of us, viewers of this channel and people who support our strategy. But one day I might do a covered call video to dumb down certain concepts or simplify things that took me a while to understand myself. But the only worry for me is beginners who get attracted by all these hype terms and jump into covered calls, jump into leverage, jump into high yields. And then they hear asset allocation is a good strategy because it diversifies you globally. The dangers is they think that, you know, covered calls might be okay for them, especially within a asset allocation ETF. It allows them to be properly diversified, because that is one of the counter arguments sometimes to high yield, that they just target specific sectors like financials or energy or utilities, and now they can have that and asset allocation. So it makes it look like this is a great all-in-one long-term hold. And there's just too many reasons that we've talked about on this video that it probably isn't. And you know, this is just freshly out, right? This newly released October 10th. So it's only been out for 2 months. Has a management fee of 0.75%. Of course, on the high side, you're paying for that service of getting covered calls and leverage. But yeah, I'm going to make I guess a bold prediction that I don't think this particular ETF is going to do that well. We'll revisit that in 3 to 5 years, I guess. And that's it for this video. And thank you so much for your support. And I hope to keep churning out videos at a more rapid pace. See you in the next one.